The United Kingdom economy is in a suffering mood and could be worse for investors. The nation has been combating short-term pressures such as rising energy prices, supply shortages, and slowing growth. But the malaise of the UK economy is not just due to these recent short-term pressures. There are several long-term factors, such as poor productivity, low investment, and the impact of Brexit, which have magnified the UK's short-term problems. The inflation has imposed low confidence, uncertainty, and discouragement to investors. The UK is undergoing a cost-push factor, not strong demand. Therefore, prices are going up, but real wages are not. In fact, workers are struggling to keep wage growth up with inflation, causing the sharpest fall in real income for 2 decades. The TUC claims that with inflation forecast to rise to 13% and nominal wage growth struggling to reach 5.5%. Thus, the UK could be going through the worst real wage falls for 100 years. The 13% inflation is likely to fall back after winter, but it isn't just an isolated experience. Real wage growth has been poor ever since the great financial crash of 2009. Welcome to Savvy Economist. In this video, we will discuss present economic issues surrounding the UK economic woes and how it affects investors. Please watch, like, and share this video. Drop your comments and observations below and subscribe to the channel for more videos like this. Let's dive right in. The UK economy unexpectedly shrunk for 2 consecutive months, according to new official figures. Economists warned that it could be bad for business leaders as the nation could be heading for recession in this year and the next. In April, the GDP, gross domestic product, dropped 0.3% to the previous month. According to the Office for National Statistics estimate, a 0.1% forecast will result in 0 GDP growth in February and 0.1% drop in March. Manufacturing companies reported being affected by rising fuel and energy prices, said ONS Director of Economic Statistics Darren Morgan. Other economists have predicted that the economy will shrink in the third quarter after the Q2 reduction by 0.1%. This would mean that the UK enters a technical recession for the first time since lockdown restrictions ended, Jake Finney, an economist at PwC, said. This means the economy is currently in recession judging by the little rebound in real GDP. However, the report stated that the GDP drip was due to the Platinum Jubilee as it caused 2 fewer working days for goods production and services compared to May with an additional working day. So, it was expected that it would bring about a drop in activity. The 0.1% drop over the 3 months from April to June was only half as bad as some economists thought. Nevertheless, given the backdrop of the global squeeze on incomes due to soaring energy prices, no one can say this drop in activity is just a blip. The squeeze on the hard-pressed consumer is tightening its grip, with activity in consumer-facing services down by 4.9% compared to before the pandemic. And with France, Italy, and Canada seeing growth, no one can say this is a stellar economic performance. The World Bank forecasted the UK recession to last from the ending of 2020 to the early 2024 due to the large impact of the hit in standard of living, energy price, and pressure from the Ukraine war. Even though Liz Truss announced a cap on domestic energy tariffs last week along with the tax cuts which could reduce the hit on the economy, a whopping sum of £100 billion, $116 billion, or more was added to Britain's already stretched public finances. British residents have already started feeling like the UK is in recession. According to Kingdom the Na, who owns a bar and restaurant in Chester, his business is already in a survival mode. I think we are not too far away from it because of the consistent blows we're getting from energy bills, from people not going out, to the cost of living. It just seems that's where we're heading, he said. It's not about making money. It's not about trying to expand or trying to grow our business. It's just about stabilizing the business, especially after the pandemic over the last 2 years, he told the BBC. Aside from Mr. The Na, other business people are facing rising costs with everything from poultry to vegetable oil. But the money in their customers' pockets is going down. There's also suggestions that the reason for change in consumer behavior and drop in the demand for energy is the hike in power prices. Electricity prices increased by 54%, a surge even to a new prime minister. Aside from gas prices, the interest rate has also increased. The Bank of England has clearly stated its stance to remove inflation, even if it leads to recession. This was contrary to their statement from the post-financial crisis economy, where the bank has often tolerated cost-push inflation with zero interest rates. Now, they are committed to doing whatever it takes to reduce inflation, even if that leads to recession. The only change we are having with that decision is that many households have become accustomed to ultra-low interest rates, and even modest rises in interest rates will increase the cost of borrowing. Higher interest rates will also increase the cost of living for borrowers, which will further lead to lower business investment due to high borrowing cost. The housing market is another constraint. Prices have been attaining new highs without break, making it difficult for first-time buyers to afford a place. More so, properties are also in short supply, especially in places like London, the engine driving the national economy. Housing is the most visible drain on consumers, but wages are lagging too. In 2019, wages in the UK trailed far behind those in the US and Canada. Unfortunately for the Bank of England, only a third of current inflation is caused by increasing energy prices. That's because inflation is revealing in other areas of the economy like goods and services. But the recent prediction could mean worse for the energy market, as a rise in gas and electricity will hit households who are already struggling to make ends meet. It is true that the high cost of living is in lots of countries in the world, especially Europe with its dependency on Russian energy sources. But, by quite a few metrics, the UK is being hit harder than other economies. US inflation is lower with some metrics compared to the UK. The UK has one of the highest inflation rates in the OECD, coupled slowing economy. A key factor in this change in economic performance is labor productivity. Labor productivity grew by around 2.5% in the post-war period, but this trend has been broken in the past 15 years. The fall in productivity is related to various factors, but one of the obvious ones is the low level of investment in the public and private sectors. The fall in productivity growth means lost output and input in the nation's economy, which further affects the government finance. One issue that has had a major impact on the UK economy since 2016 is Brexit. Ever since they left the single market and custom union, it has hiked the cost of trade with Europe, which is their main trading partner. The low trade has also caused an increase in their current account deficit. It also affects the value of pounds, which has weakened the sterling and increased the price of imports. This is also the reason why gas prices in the United States are falling faster than in the UK. Consumer prices surged by 9.1% in the year through May, the most for 40 years. The Bank of England expects inflation to accelerate again when energy bills rise over 11% in autumn. Earlier, the Confederation of British Industry joined the chorus of organizations warning of the looming potential for a UK recession. The CBI downgraded its economic growth outlook for the full year to 3.7% from 5.1%, and for 2023 to 1% from 3%. Last week, the OECD said Britain had the weakest outlook of any major economy outside Russia, with growth of 3.6% in 2022 and zero growth in 2023, down from 4.7% and 2.1% estimates earlier this year. It expects consumer price inflation will average 8.8% this year and 7.4% in 2023. Up until now, most economists, and even the Bank of England, did not expect a recession to start until the final quarter of 2022. According to a statement from the National Institute of Economic and Social Research, the UK economy is expected to fall over the next 3 months. Capital Economics said there was now a greater risk that the economy will shrink by 0.2% between July and September before worsening. What do you think about the present condition of the UK economy? Leave your comment below. Hope you enjoyed watching this video. To support us, please watch, like, and share our videos. You can also subscribe to the channel and turn on post notifications for more videos like this. Thanks for watching.